Hello everyone, this is Kyle Wang. I just wanted to update you on some of my research with mutual funds this week. I've been really interested in following these super investors and their disciples and looking at how their funds have performed along with their top holdings and their investing methodologies. So what I noticed so far this week was that looking at all these mutual funds, their price to book ratios all tended to be around the same, reasonably low but very consistent, but their price to equity ratios differed very, very widely. I think this is a great testament to how a lot of these investors, these super investors, follow the methodology of Graham and Dodd, right? But at the same time, they managed to really infuse a lot of their unique flair or their unique investing style into it. So I thought it was really, really cool when I looked at these funds this week to see this actually reflected. In addition, I've seen that a lot of these value funds, especially over the past 5 or so years, have kind of been struggling a bit just with the volatility of the markets and sort of coming out of that recessionary period. But it's interesting to note that when you look at these funds over a longer cross-sectional time, like say 10 to 15 years, they almost always overwhelmingly overperform based on their respective benchmark. So the first fund that I looked at was the Keeley Small Cap Value Fund, or KSCVX. So this fund, was started and founded by John L. Keeley Jr., very, very famous value investor, and it finds opportunities with companies that are undergoing some sort of restructuring, right? So this could be spin-offs or companies that generate refranchisings very, very often. For instance, in their top holdings, Denny's is one such example. This fund has been very, very successful. It outperformed the Russell 2000, small cap, right, by over 200% since its inception. And Keeley also went about creating his succession plan, right? He ended up training his nephew Brian, who he brought on for assistant manager for his funds. And Brian's been very, very good for the company or for the fund, for the reason that he has a lot of experience in risk control and risk management. So ever since Brian joined the fund, they've been able to cut a lot of their holdings from 165 to 115, chiefly due to the more stringent risk control measures that Brian has put in place. So for instance, they've always been historically very, very overweight energy in the industrial sector, which has really hurt them in recent years. But with Brian's sort of new risk-reward criteria, they've been able to mitigate a lot of that risk going forward. Finally, so that was pretty much my biggest concern with this fund. I mean, again, they have a very, very proven history, proven methodology, but I was just wondering if this would, I think Morningstar described it as key man risk, if John Keeley leaves, what do we do then? But I think that with the way the management is going and the decisions that have been made, I think the Keeley fund would still continue to outperform in the long term, and I still think it's a worthy holding to have on our spreadsheet. The second fund I looked at was the Fairhome Fund, or FAIRX, right? So this fund was started by Bruce Berkowitz, and Berkowitz, of course, is one of the biggest names, right, in value investing. While his methodology is bottom-up and value-based, it's very, very interesting that he is probably the biggest proponent of conviction that I've ever seen, right? He only has 11 holdings in the fund, all in the complex financial sector. I thought this was really great. This is kind of the gut of steel, no holds barred kind of value investing that is kind of the stuff of legend, really. Even though the fund took a really big hit in 2011, just because financials itself was really, really struggling, but Berkowitz said that it was, despite the fact that the business trends for his companies were in a very, very good place. The issue is the stock still traded down just because people at that time were behaving very irrationally. Everyone was thinking that a double-dip recession was coming. Everyone was convinced that Europe would just completely fail across the board. So he boldly stated that to give him 3 to 5 years to prove himself and to prove that his latest round of top holdings and stock picks will certainly come to fruition. So even despite these sort of setbacks, his fund has still outperformed the S&P financial sector by over 280% since inception, and it's certainly really proven itself, and it's really saying something to think that kind of an investor can take only 11 stocks, right, no diversification at all, completely in the financial sector, perhaps the most complicated sector out of all of them, and still be able to create such great performance over this period of time. I think really speaks volumes about the quality of his investments and judgment. What I really like about Berkowitz is his focus, right? If you look at his fund family and everything, he doesn't try to create a ton of products to get a lot of investors with a lot of marketing or anything like that. He only he kind of adopts the same attitude toward his funds as he does his holdings, right? He only concentrates on a select few, very few, and he spends a lot of energy making sure that his conviction is rock solid and that these funds will perform. So while the fund is closed earlier this year to, I guess, cull out the non-true believers, right, to kind of create a more stable shareholder base, it actually opened about 2 weeks ago. And I think this might be a good time for any investors who are thinking to get in on Berkowitz's fund in a time that, many people aren't exactly excited about him, and really see a lot of great profits and a lot of great returns coming forward if we can stay in it for the long run. Another fund I looked at was First Eagle, right? So First Eagle is also run by sort of belongs to a fund family run by Jean-Marie Aviar, again a very big value investor name. But this particular fund, so this is the First Eagle USC Value, is run by one of his disciples, or Matthew McLennan. I really enjoyed looking at the disciples of these super investors because many times, from all this research I've done, it really does seem like if this methodology, if these value investing methods can be successfully, inculcated in a disciple or whatever, they continue to really provide great returns, and oftentimes they still sort of fly under the radar, right? And they're still kind of overshadowed by their mentors. So Matthew McLennan is one such disciple. This is a large cap fund, of course, a very different strategy compared to those before. It opened in 2011, so still, in a sense, relatively young, but FEVCX actually has a deferred load, and it follows Aviar's kind of long-term, very disciplined approach. So it's a very different strategy from Berkowitz, as I mentioned before. Capital preservation for this fund is first priority. So they look for significant margins of safety, carry a large cash balance also, which sort of makes it a little unique. But they usually try to carry like a 10% cash balance so that they can pounce on opportunities immediately instead of having to worry about shaving off other positions or anything like that. So as the fund has grown, what I like to see is that the fees have actually gone down for investors. So the average expense ratio was 1.23% in 2010, and recently it's only 1.17%, right? And this is chiefly due to the amount of capital the fund has been receiving, the volume of new investors coming in. Morningstar actually finds that this fund is below average territory in terms of fee structure with comparable large cap funds. So while the fund has currently has a higher than normal cash balance, which is a little worrying to me because they have about almost like 20% of their holdings in cash, of their assets in cash right now, and of course that's always not a good thing, right? You're always going to lag behind that way. But I think this speaks more to just that the managers haven't necessarily found many bargains in the current market, and honestly I would prefer that they do keep this cash in the case that these good opportunities then arise, than to just put them in certain positions where they don't have that conviction, just to say that they have all of their assets fully invested. So I really do like the direction management is going with this firm. I really like the history of it. The other thing is I also kind of looked at the top holdings, right? Their diversification, that sort of thing, and it is about 20% tech, right? So technology, which is generally very volatile. But I do like management's choice with their technology holdings. For instance, they've invested in Cisco and they've invested in Oracle, right? Because and these investments are very much in tune with management's view of finding companies with very consistent cash flows and that generate a lot of cash, stable cash streams, cash generation. So overall, I think this firm is in a good place. Matthew McLennan has pretty much proven himself. He's had a long history with Aviard's parent company, and I think that as a whole, the fund is poised for success coming forward. Next, I looked at the Chou Income Fund. I was particularly interested in Chou just because when I looked him up on Guru Focus, as a disciple of Prem Watsa, he also had this amazing, value investor success story, which resonates a lot. I feel like gives a lot of prospective value investors, like myself, a lot of hope. I'm sure you already know it, but just to summarize, he came to Canada with $200 in his pocket. He became a telephone repairman. And somehow, I'm not sure how, it doesn't really say anywhere, he somehow encountered the works of Graham and Dodd and started reading through it, and he thought, wow, I found my calling, So what he ended up doing was he joined up with like 5 other telephone repairmen, and they created this little investment club, and the rest, quite frankly, is history, and he just rocketed toward the value success story he is today. So getting back to this fund, though, the Chou Income Fund, seeks to provide current income, capital appreciation, and on a secondary mode of capital preservation. What worries me about this fund, though, it is 80% of its net 80% of its net assets are fixed in are in fixed income securities. But what worries me is that this fund seems a little more experimental. It doesn't have the history of the Chou Associates Fund, the very larger kind of flagship fund of his fund family. So he owns a lot of corporate junk bonds in this fund, and in his interviews and such, he's even recently stated that junk bonds are much harder to play now because their prices have risen so much. But I'm not necessarily convinced that this fund is still sticking to his value roots. It underperformed the ag ever since inception by quite a significant amount, and I understand that a couple years back, Francis Chou kind of had this sort of experiment with TARP warrants. He had a very big hunch that the warrants, would end up turning over a very, very large profit, but unfortunately, he completely got burned. So, a lot of credit to him for in his statement to investors that he really did admit to all of these mistakes. But I don't think this fund in particular is a good investment. I've seen on the spreadsheet that another analyst had put on the Chou Opportunity Fund, which I was actually thinking of looking into, but as a whole, like compared to the Chou Associates Fund, I don't necessarily think the Chou Income Fund is a very good investment. I think I'm going to remove it from the list with further consideration. In addition, I also examined Longleaf Partners Small Cap Fund. This is managed straight up by Mason Hawkins, so no disciples here. And this was founded in '89, right? So this fund is probably my favorite one. It has exceptionally impressive returns, topping averages of all mid-cap and small cap categories since its inception. It's got a very patient strategy. Hawkins invests in a lot of these small to mid-sized companies trading at a discount of 60% or more from the stock's intrinsic value, right? And this is a very, very interesting parallel to Graham's own kind of rule of thumb, right? And in a sense, almost a stricter metric because Graham really advocated for that 66% of net asset value, right? So they value. So Hawkins Fund evaluates a lot of investments based on three things, namely business model, management, and price, right? So in the end, they own only 20 or so stocks, so they're very, very patient and they're very picky with their stock selection, and they completely ignore index weighting. So in a sense, they're sort of like Berkowitz, but they're more diversified. They don't really stick entirely to one sector. But overall, I think this firm really has really proven itself in terms of management and track record, and it just seems to continually deliver consistent results, right? And that consistency is what we really look for in value funds, really regardless of how much it outperforms or even if it underperforms, right? And so far, it really seems to be extremely shareholder friendly and really consistent. I was also disappointed by two other ones I looked at in terms of disciples, right? So I followed FBRVX, which is Chuck Akers' old fund before he went off and founded FAIRX, right? Which I think is also on our spreadsheet. So FBRVX was run by Akers' disciples, right? And the thing is, these managers, even when FBRVX was merged with Hennessy funds, these advisors, stayed with the fund and was incorporated within Hennessy. But when I looked at Hennessy more and more, their entire kind of methodology, their investing philosophy was quite different from that of Chuck Akers. And even though FBRVX, which is now the Hennessy Value Fund, still kind of maintains that it is a value fund, like just looking through the statements of additional information and the 10K, not the 10K, but just the statements of additional information, I noted that the managers no longer eat their own cooking, and for that reason, I wasn't really convinced that they were still stuck with their old value principles. And similarly, I looked at the Gabelli SRI fund, right? And this is a newer no-load fund. This started up in 2007 or 2006, 2007, I think, and it's run by Gabelli's disciples, but they too do not eat their own cooking. So it's just that I really wish that these value managers, these disciples, would continue to really put in their own assets, because I think it definitely speaks a lot to the credibility of what they're doing, what they're managing, and I can't really think of any reason why they wouldn't, quite frankly. Well, I hope that gives you some insight on my mutual fund research this week. Looking at these different funds and their methodologies has definitely been very interesting, and working on the spreadsheet has also been a great opportunity. So thanks for watching and listening to my video.